Good day to all. This is the second part of our discussions involving the trade-off between risk and return. If you can recall, we stopped at this part and then we said that we can actually do some approximations of the unknown probability distribution for future stock returns by assuming that there is a normal distribution. So this is where the bell-shaped curve would take into place. And by using the normal distribution, we can now incorporate concepts of variance and standard deviation. So the variability of stock returns would be described or can be described by its mean and its variance. So the variance, which is our symbol here in squared, is a measure of volatility in units of percent squared. And then how do we get that? So basically, we get the difference of the return for that particular year, for example, or time period, depending on the given data or information or table, and we deduct the average returns. So the difference is squared, and then this is where our sigma notation would take into account. So the summation of the differences squared, of course, of the return again for that particular time minus the average return, or also known as the mean return, divided by the n minus 1. So incorporating degrees of freedom and, of course, our allowances for possible errors. Then standard deviation is a measure of volatility in percentage terms. So the two actually variance and standard deviation, or SD for the latter, are in percentage terms because we actually get the mean return and get the difference of the return for that time, or T. That's why you have R sub T, capital R, by the way. And then we deduct that two again, and then we squared. So basically, those are percentages. So if we get the square root of the variance, that is standard deviation. So we can see here a sample of that. So from 1994 to 2006, we have our returns for the particular year, and then we get the total, and we divide with n minus 1. So how many items there are? On the given table, we have 13 items, less 1, so that's 12. And then that's for the variance though. But for the average return, that's simply the mean again. So when we say mean, the average of the returns as provided. So that's why you get the total 159.4 divided by 13, we get 12.3. And then, or we can recheck this one because what is used here is 12.5. So with that, let's say assuming this is 12.5 again, and then we now deduct from our given returns. So this is R sub T, then minus R with a bar, horizontal bar above that, which denotes mean or the average return. And we get our negative 12.4 in that case. So we have to take note, guys, that the 12.5 is actually a positive average return. So negative zero point 0.1 minus the 12.3, or again 12.5, we can again recompute if you would like to. So this could be 12.3 though, because that would result to negative 12.4, and so on. Just have to follow the steps, this minus this. And then after that, the difference will be squared. So that's why we have here R sub T minus R bar, horizontal bar again above, or the mean, and then squared. Then we get the total, 4027.2, and then we divide that with n. So the number of items here, or the population or sample items, that's 13 minus 1, that's 12. So we get 335.6, and the square root of this one is 18.3, expressed in percentages. So the standard deviation is 18.3%, while the variance is 335.6%. Moving on, we have the average returns and standard deviation for equities, bonds, and bills. So again, as what we've explained in our part one, that comparing the three asset classes, so equities would have the highest for the nominal and real returns in terms of the average and standard deviations. So another one is the relationship between average or the nominal return and a standard deviation for stocks, T bonds, and T bills. So you can notice that the standard deviation or SD is replacing the risk, which is also true since SD actually incorporates the concept of risks and the average returns or the mean returns. So it's still true that bills would be the lowest, followed by bonds, and the stocks would have the highest risks and returns. Then investors who would like to have higher returns have to take more risks. This is also true, very true. And then the incremental reward from accepting more risk is constant. So the differences as we go along the way, or so we go upwards, would be the constant or the same all throughout. So in other words, the risk premiums would be the same. Then diversification is again using the portfolio approach wherein we will have multiple or at least two types or classes of investments that we place our monies in or into. So the average returns are here, and then these are the standard deviations for the 11 stocks that we have here as a sample. So this is in US anyway. And then from 1994 to 2006, the standard deviation of the typical stock, so allow us to minimize this so that we will be able to see the contents. In the US was about 60% per year, while the standard deviation of the entire stock market was only 19.8%. So in other words, if we manage to have investments in the portfolio and then that particular management is done well, we can minimize the standard deviation. Again, look at the bottom part here, the note that the SD or standard deviation of the stock as a whole is 60%, while the SD for the entire stock market, so meaning combining all types of shares, would be 19.8% only. So if we have individual stocks, they would have higher risks as compared to composite or group. All right, and then other concepts. So again, individual stock prices would have higher volatilities than the price volatilities of a portfolio of all common stocks, not just two. So of course, the more there are, so the lesser the volatilities or the SD or standard deviation. So how come? How can the SD of one be higher than the SD of all or combination? So again, the concept of diversification. And then the ups and downs of individual stocks can partially cancel the other. So it's possible that these groups of stocks would have losses, but the others have gains higher than the losses. So overall, we are still gaining along the way. So that's the power of diversification. And then we also have here comparison of the returns on Coca-Cola and Wendy's International. So for example, for blue is Coca-Cola and Wendy is red. And then if we can see here 1994, so for Coca-Cola, there is a bit of positive, but then majority is negative as well as entire Wendy's, and we compare all other else. So by combining the two, at least for example, by diversification concept, we can manage the returns as well as the risks prior, of course, so that we'll have still positive returns. So that's the concept again of diversification. Then we can notice that the two stocks did not always move in sync. That's very true, even with any other types of shares. And then the net effect is that you have to minimize again for a while. So hopefully this will not have impact with the learnings. The net effect is that the portfolio is less volatile than either stock held in isolation. Again, that's true. So if we do it in composite or group, so the volatilities would be lower. And then we have here the average returns and standard deviations of the portfolios now are combinations of stocks and bonds from 1972 to 2006. SD at the bottom, so the risk, and then the average annual returns for the y-axis or the left side. So we can notice again that if we have 100% stocks, then entire stocks for all. So we would have the highest risk and highest possibilities of returns. And if we have 100% bonds, then we have the lowest. But if we do the combinations, it's possible that we can manage such, but in between of the two extremes, of course. Then what about for standard deviation of the portfolio and then the number of stocks in the portfolio? So by this, interestingly, we have now the incorporation of the two types of risks, meaning to say that the standard deviation can be dissected further into systematic and unsystematic risk. To differentiate, systematic risk is the risk in the system, which is the market we're in. No matter what we do, we cannot eliminate that even we have diversification, because again, that's already in the system. What we can manage is the unsystematic risk, which is, of course, all other risks not incorporated in the market. So we can minimize the risks by doing the portfolio approach or the diversification approach. So we can notice that for the systematic risk, it's SD for the entire market at 19.8%. But above that, we can manage. So we can notice that with one stock, we have the, of course, highest standard deviation here for the portfolio. And then we have the highest risk in SD, but of course we can translate that into returns as well. So highest risk, highest return, and then we go lower. So if we have 11 stocks, we actually have the lowest SD, but then the lowest also exposures to returns and highest returns. So that's a way also of saying that although we manage to minimize the risk, but we also lessen our chances of positive returns. Then the risk that diversification eliminates again is called unsystematic. That's already beyond the market system. While the system or the market risk cannot be eliminated, it remains even for a diversified portfolio. Then this is where we formally discuss the two. So diversification reduces portfolio volatility, but only to the point of 19.8%. And then below that, that's for the systematic, which we cannot eliminate. Above the line of 19.8% is the unsystematic that can be eliminated through diversification or portfolio approach. And then what really matters is systematic risk. Let's minimize this one. How a group of assets move together. So it's in the system, we would observe like the movements or the fluctuations in the market. And then we now also incorporate our diversification so that as a whole, we can minimize the risks. Then for the various asset classes, so we just have to revisit the terms to formally close our discussions. A trade-off again arises between the risk and return. So does this trade-off hold for individual securities? And then the answer is yes. But of course, for individual securities, we have the highest risks and then the highest returns. So we have here SD, both systematic and unsystematic, of course. So these are the types of the securities or stocks that we've had. SD, x-axis, average return on the y-axis. So of course, they're scattered because they have different values. And then we can say that there is no obvious pattern here, right? So as we can see, there is a summary here. Anheuser-Busch had a higher average return than Archer Daniels Midland and with smaller volatility. So sometimes it does not follow, right? So that's why we said it is a general rule. Because remember, average return is directly proportional with our volatility. And then on another occasion or hand, American Airlines had a much smaller average return and then than Walmart with similar volatility. So supposedly it should have been like equal. So that's why we said that as a general rule, it would follow, but not for all. And then the trade-off between standard deviation and average returns that holds for asset classes, well, this is now our realization, does not hold for individual stocks. So the reason again, SB contains both systematic and unsystematic risk. So initially our summary is generally speaking for our asset classes. So bills, bonds, and stocks. But when we now analyze individually for the stocks, for example, then it does not follow anymore for individual stocks. And then this is because investors can eliminate unsystematic risk through diversification, but the market only rewards the systematic risk. So if we ride with the market, then we will be rewarded. So that's the point also. And then these are the risk premiums around the world. So just a sort of showing. And then the average real returns on equities, of course, would have impact and then on the standard deviation and of course vice versa standard deviation actually on the x would have impact on the average real returns but they have direct relationships but if individual again for the stocks that does not hold true so we think of the classes and then we have here the risk premium versus bills. So in other words, the risk premium is the difference between equities, for example, and other securities. All right, this is the end of our discussions for part two of the trade-off between risk and return. Hopefully you learned something from this session. Thank you very much and God bless.